The late great American comedian Bob Hope once described banks as places that will lend you money if you can prove that you don't need it. It's a cynical view that some would agree with, but the banking industry in the UK is changing, providing greater competition for consumers and small businesses, as well as more choice for investors looking to gain exposure to the market. Hello, I'm Mark Dunne, AJ Bell's Head of Research. Welcome to another edition of Breaking the Mould, our regular look at the financial markets. One of the positives that developed from the financial crisis is the emergence of newer, smaller lenders, which have been nicknamed challenger banks. Shawbrook, One Savings Bank, Aldermore and Virgin Money have all listed on London's main market in the past 15 months to access the capital needed to boost their lending, increase market share and strengthen their reserves. They're providing an alternative to a market that has been traditionally dominated by FTSE 100 members HSBC, Barclays, Lloyds and Royal Bank of Scotland, while London-based Standard Chartered offers exposure to the emerging markets. These newer players, along with 20-year-old Virgin Money, are taking advantage of the larger banks scaling back their lending. In doing this, the new kids on the block also offer strong investment cases. The emerging names in the market have a long way to go until they can generate the profits that the more established high street banks have reported recently. Aldermore, for example, made a £40 million pre-tax profit in the 6 months to the 30th of June, while HSBC made a taxable $13.6 billion profit during the same period. Don't let that put you off the so-called challenger banks. There's more to weighing up the investment case of a bank than looking at the size of its profits. Return on equity, for instance, is a key metric for assessing performance. It is expressed as a percentage and shows how much profit a bank generates from the money its shareholders have invested. Shawbrook, for example, has a return on equity of 25%. That's well above the industry standard of 15%. This means that for every £1 investors have given the bank, it has turned into £25. Barclays, on the other hand, is forecast by Investec analysts to report a 3.5% return on equity by the end of this year. So Shawbrook is the more efficient bank here by a long way. You can see on the chart just how some of the others shape up in this metric. The size of return on equity is usually the result of a healthy core business that is taking money on deposit from individuals and companies and then lending that money on in the form of loans and mortgages. The difference between the interest rate charged to those it lends to and the interest paid to its depositors is called its net interest margin. The higher the margin, the more money the bank is making, the more efficient it is. Aldermore has a 3.6% net interest margin, while Lloyds makes 2.6% from its core lending operations. Again, you can see how the various industry players are faring here. Now, if the financial crisis taught investors anything, it is that if you're going to back a bank, make sure there's enough reserves to withstand tougher economic times when the number of people defaulting on their loans will rise. Barclays has a 11.1% core tier 1 capital ratio. Now this figure is risk weighted, but in its simplest form it means that for every £100 it has on its loan book, it has £11.1 in reserve to help it absorb any losses. Again, the higher the figure, the better. Shawbrook is in a stronger position here with a 15.2% ratio. So over several metrics, the smaller players are outperforming the larger banks while being free from the continuing product mis-selling fines ratings of things like PPI that continue to wipe hundreds of millions of pounds off the profits of Lloyds, HSBC, Barclays and RBS. Now, I'm not saying that you shouldn't look at the larger banks if you want exposure to the industry, but make sure that you include the smaller lenders in your research. One final point to remember is that all banks, big or small, must pay an 8% surcharge on profits above £25 million from January, and this will reduce the amount smaller players have to lend in the coming years. Thank you for your time, and we'll see you next week.